Let's talk about income versus cash flow. Okay, it's very important to understand the difference between income and cash flow for both accounting and tax purposes. If you don't understand the difference, you are going to confuse yourself in terms of, especially when you are trying to do your bookkeeping, and especially when you are trying to do your tax returns. If you're doing that on your own, you need to understand the difference between the two, especially for these purposes. Okay, so in terms of income, for a property company, income is all inflows, all the monies that come into your business, which include rent, municipal recoveries, operating cost recoveries, other sales that you make within your thing. So let's say, for example, you have a student accommodation as your strategy, and within the student accommodation, you have maybe vending machines as an example. And then therefore you have vending machine sales that is part of your income stream. So those kinds of things. So you've got municipal recoveries when you recover operating costs like electricity, water. Sometimes you can even recover your sewerage, and then other things like security and cleaning services. There's a whole host of things that you can recover when you run a property portfolio. Now, not every portfolio can recover all of these things. Sometimes you can only recover rent, and then you put in, say, a prepaid meter for your electricity and your water, where the person or the family that lives in your property has to prepay the electricity and their water, and then you don't have to monitor that. In other cases where it's impossible to put in prepaid meters, you then have to calculate each tenant what their usage is, and then bill them based on that usage. So there are different ways that you can collect your rental, but all that money that you collect, all the rentals that you collect, all the municipal costs that you collect, all of the cost recoveries, the operating costs, all the other sales that you make, all those sales are all part of your income. All those inflows of cash is all part of your income. Okay. Now, net income before tax is an important concept, because that's the number on which you calculate your tax. So net income before tax is all those incomes I've just spoken about, minus or less all your expenses, not of a capital nature. Now, that's an important aspect. You need to deduct all your expenses that are not capital in nature. So, as an example, your bond. When you repay your bond is split into two different aspects. On the one hand, you've got interest, and on the other hand, you've got your capital repayment. Then you've got other things like your bond costs, your insurance, your bank charges, and possibly a whole host of other costs that the bank will charge you within that bond repayment amount. You need to analyze all of those expenses. The capital portion, which is the reduction of what you owe the bank, that portion is not an expense. That is a capital portion which comes off your balance sheet, not your income statement. Your income statement only shows your income minus your expenses, giving you a net profit. The capital portion goes to your balance sheet, where, let's say your bond was 100,000, and the capital repayment within your bond amount is 100 Rand. Then you reduce in your balance sheet the 100,000 that you owe the bank, you minus the 100 Rand, then you're sitting on 99,900 Rand still owing to the bank in your balance sheet. But it doesn't affect your income statement. It doesn't affect your net profit, and it doesn't affect your tax that you're going to pay. If, just for the purest of calculations, you've made 10,000 Rand rental income for the year, and all your expenses, your interest on your bond, your bank charges, your insurance, your municipal costs, which you couldn't recover. So the general municipal cost that is for the landlord's cost, your cleaning and security that you couldn't recover, and all other, your gardening services that you couldn't recover from your tenant. After subtracting all those expenses, you get a net profit. Now, let's say those expenses were 6,000 Rand. So your income was 10,000, your expenses was 6,000, your profit is now 4,000 Rand. Now that profit is what is taxable in its purest form without doing any other fancy footwork, any other calculations that you can maybe deduct your taxes on. If you have a 13.6, you can then deduct 55% of your tax and so on and so forth. There's a whole host of other things that you can do. But let's say in its purest form, you've now got 4,000 Rand profit, and it's a company that you are running your business in. You then take 28% of that profit that you've made, and you calculate that as your tax. So that would then work out to be 28% of 4,000 is, let me do a quick calculation. Sorry, my brain isn't functioning this morning. 4,000 times 0.28, that's 1,120 Rand. So your net profit after tax then is 2,880 Rand. So your net profit before tax was 4,000, your income was 10, your expenses was 6, your net profit is 4, 28% tax, then your net profit after tax is then 2,880 Rand. And that's how you calculate your net income. All right, so you've got your income, your expenses, your tax, and your net income. Your net income before tax, your tax, and your net income after tax. Okay, so net income after tax is your gross income, less all your expenses, less your tax, and everything that is not of a capital nature. Now, where that differs to your, let me just get to the next stage there quickly. Okay, there we go. Where that differs to your cash flow is that in your cash flow, it is not just your income and your expenditure. You also deduct your capital, because this is where it tells you how much cash you've got in and how much cash you spent and how much cash you've got left over. Now, when you pay your bond, even the capital portion of the bond is a capital outflow, is a cash outflow, but it is not an expense. It is a capital repayment. So therefore, it doesn't affect your income statement, but it does affect your balance sheet, and it does affect your cash flow, because it's actual cash that you're paying to the bank as part of your bond. Other things that doesn't affect your income statement but affects your cash flow are things like if you do a capital improvement as opposed to repairs and maintenance. Now, repairs and maintenance you can deduct as an expense in your income statement, but a capital improvement you cannot deduct as an expense. You can only add that to your asset value. So your asset value grows, but your cash reduces, okay? Because you're spending money on a capital item which increases the value of your property, but reduces your cash. It does not, however, allow you to write that off against your expenses unless you are in a 13.6 example, where you can deduct capital. When you do improvements, you can then deduct capital from your tax burden. So that's the difference there in terms of income statement and your cash flow statement. Your income is only income minus expenses minus your tax. Your cash flow is your income minus your expenses minus all capital expenditure minus your tax, and that gives you your net cash flow. So your income could be 4,000 Rand minus your tax is 2,880, but then there's 880, let's make it simple. Let's say there was 880 capital that you had to pay against your bond over and above the interest. That then leaves you with 2,000 cash. So your income, your net income after tax is 2,880, but your net cash flow is only 2,000 Rand. So that's where you can see there'd be a difference between your income and your cash flow. And that is very important to remember, especially from a tax perspective. But there is a caveat that if you are in one of those tax havens, like the 13 SECs, like your 12 Js, and other tax havens that there are for property, you could have a better cash flow than you do income tax. And in other cases, you can have a better income after tax than you do your cash flow, depending on how you structure your tax based on all of those tax havens that you could use when you build your property portfolio. I unfortunately don't have enough time to go through all of the different tax havens that there are, but suffice it to say, when you're in one of these tax havens, you could save a lot of money and make a lot more money and a lot more profit using these tax havens and using the receiver of revenues money in order to make more profit. Okay, so I'm going to stop there.